So you mentioned BHP is one of your top performers from the recent reporting season. So let's go and touch on BHP's results a bit further. So BHP reported a full year revenue of $61.3 billion, up 40% year on year. They recorded an underlying profit of $17.1 billion, up 88% year on year. There was a final dividend paid to shareholders of $2 per share, which results in a full year dividend of $3.01 per share. Three other takeaways from the recent BHP results were the proposed oil merger with Woodside Petroleum, which BHP would own 48% of the newly merged company, and Woodside would obviously own 52% of the newly merged company. They announced they're going to invest $5.7 billion into the Jansen Potash project. And lastly, they also announced that they're going to be unifying their dual listed structure, as BHP is currently listed also on the London Stock Exchange as well, the Australian Stock Exchange, and they're going to unify this dual listing structure. BHP did see a bit of a sell-off following their earnings report, with a few analysts linking the actual sell-off towards the unification of their dual listed structure. There was also a bit of a miss on expected higher unit costs for producing iron ore moving forward. So Ray, can you just give us your takeaways from the recent BHP result and what you see moving forward for BHP?
Thanks, Paul. Yes, certainly BHP was one of the more eventful results this reporting season, which otherwise overshadowed a very strong underlying result. So the first piece of major news was the decision to merge the petroleum business with Woodside. Look, the price achieved for the merger of the petroleum business was in line with our fair value. So we think the merger price was struck at a fair deal for shareholders. Number two is we're quite supportive of the decision to divest the petroleum business because it reduces BHP's exposure to fossil fuels and certainly will assist it with its ESG credentials. If you think about fossil fuel generation, it is a sunset industry. The world is going to transition away from oil intensity to electrification, and it's very difficult to find buyers for these assets. So the ability to be able to find the buyer for these assets is a good outcome for shareholders, and reduces the risk that BHP is left with these stranded assets. The second piece of news from the result, as you said, Paul, was the collapse of the dual listing shareholding structure, the BHP PLC. Look, from our perspective, we're supportive of the move. It simplifies the business. The BHP Billiton component is less of an earnings contributor to the group. It just increases complexity of having a dual listed shareholding structure. The sell-off, in our view, was overdone, but largely just attributed to the market anomaly where BHP PLC was actually trading at a 20% discount to the BHP Australian and US pricing. So that saw quite a normalization with selling across US and Australian markets to basically see that spread reduced to about sort of 6%. If we look at those two pieces of news from BHP around the merger of the petroleum business and the collapse of the dual listing structure, from our perspective, they are both positive. They simplify the business, and particularly the divestment of the petroleum business will see BHP become a more pure play iron ore producer and increase its ESG credentials. What you also saw was BHP press the go button on the Jansen investment. The Jansen investment will only sort of give shareholders about a 12 to 15% internal rate of return. It's a potash project, so it's not going to add a huge amount of value to shareholders, but it does again increase BHP's skew towards another sort of secular growth industry, which is food consumption, because potash is used in fertilizers. Aside from that Jansen investment, BHP is really ex-growth. It's more dependent on the iron ore price than ever. What you saw was BHP get a realized price of about $132 a tonne in the year that just went. It didn't fully benefit from the peak in the iron ore price, $2 to $220, And subsequently, since the result, you have seen iron ore prices fall to about $150 a tonne. Even at $150 a tonne, BHP is still on about sort of a 10% free cash flow yield. It will see a reported decline of earnings at about 8% if the spot prices are maintained. But some of this will be offset by stronger coal and copper earnings into the next year. So from our perspective, it's BHP is generally undergeared. It's got a strong balance sheet, spinning out a lot of cash to shareholders. It's probably about fair value now, and that's even us assuming an $80 long run price. What we do expect from BHP is, the longer the commodity prices stay where they are, the more cash they return to shareholders. The key issue for BHP will be just how long does the iron ore price stay above our mid-cycle assumptions, and you have seen some recent steel production cuts come out of China, which drove that iron ore price fall. In our view, as global economy moves to sort of more productive infrastructure spending, we think steel demand is going to be strong for a while. So we're pretty confident that BHP will continue to sort of make good returns to shareholders.
Thank you for that, Ray. So yeah, the headline numbers with BHP were overall pretty strong, obviously supported by strong iron ore prices and even strong copper prices. The iron ore price has recently seen a pretty significant pullback from approximately $220. Now it's sitting around $140. And the market must be even pricing in even stronger pullback, because what I do have here is, even with iron ore trading at these prices, BHP will still deliver strong cash flows and therefore strong returns to shareholders. And I have here that BHP is currently trading around a dividend yield of 8% and even a free cash flow yield of 11%. So if you're considering that kind of yield generated from the production of iron ore and copper, the market must be pricing in that this is obviously transitory, and then BHP is going to have a headwind moving forward from even weaker iron ore prices and copper prices from this level. The merger with Woodside Petroleum does make sense for BHP and also for Woodside Petroleum. For BHP is going to be a stronger candidate from an ESG standoff. Their product mix now, when they remove the actual petroleum side of it, is more aligned to future commodity trends and future commodity needs. Obviously, as you have the coal assets still, and also this also does make sense for Woodside Petroleum. It makes merging these two companies makes them a stronger oil player, and BHP announced that they do expect some strong synergies through merging these two companies.